The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you. Hey, welcome back to the JamisonMoneyFarmer Advisor Show, the JMF Advisor Show. We've got some great folks in today. I've got Viki Gryska from our tax department. She actually is in our international practice group. Welcome.
Thank you for having me.
Yeah, no problem. First time on the podcast,
Yes.
so should be exciting. And we've got Sean King from Raleigh, North Carolina with us on Zoom. Welcome, Sean.
Thanks, Bobby. Happy to be here.
Awesome. Well, Sean is an international tax expert, really specializes in structuring cross-border transactions, M&A work, really helps inbound investment into the U.S. and then outbound investment for multinational companies. So he's really a great person that works with us and our multinational clients. A lot of times in initial setup of companies, he's been doing this for years. I think he and I are almost the exact same age, have some long history, I guess, together. So welcome. We spent a couple of days in Fort Lauderdale last week at an international conference. So welcome to the podcast.
Yeah, thanks again, Bobby. It's really good to be here. And yes, I guess a lot of history at this point. We'll try not to date ourselves too much, but some good history at that.
Amen. All right, Viki, you want to kick us off?
Of course, yes. So, we talked a little bit yesterday about inbound and outbound. A lot of companies, foreign companies, have decided to come into the US market, and these companies face a lot of challenges and rewards. A lot of clients that reach out to us, it's almost too late for them, and they haven't gotten the initial guidance on what to do, how to do it right. What are some of these typical issues that they should consider before entering the US market?
No, thanks, Viki. Good question. And I think, I always joke that, Google has become a very dangerous thing for the part-time tax practitioner, right? So what we find regularly is that companies have gone out and they've done their initial due diligence on inbound structuring through Google. And that has told them that you have this magical legal entity here in the United States known as the LLC. It's a pass-through entity. It's not subject to tax. And so we regularly field as an initial gating issue this notion that we should establish an LLC and presto, we won't have any U.S. tax liabilities. So one of the first things we discuss with inbound clients is the fact that the LLC, in most cases, for a non-U.S. investor, whether that be an investment group, private equity group, or a corporate body, in most cases, investing into the U.S. through a pass-through LLC is not a good idea. It's actually the opposite. That can actually cause significant tax inefficiencies for the inbound company. And so instead, we're typically looking at a C Corp type of structure. Why is that? If we invest through a pass-through U.S. entity, that can expose the non-U.S. owner or parent company to U.S. tax filing obligations. So that the non-U.S. parent would then have to file a U.S. tax return, which when they learn that typically runs them off pretty quickly, right? So those are some of the initial things, those myths that we have to dispel to some extent early in the conversation. Now, that's not to say an LLC isn't an appropriate legal entity form if you need that from a structuring standpoint in terms of maybe granting different rights or obligations to the different investors or different parties involved in the transaction. You could use an LLC, but maybe make a check the box election to treat it as a corporation for U.S. tax purposes. So there's flexibility there, but the point in this is that leaping to the conclusion on the initial gating issue of entity formation or entity choice is typically a bad idea. So we spend some time there. We also talk about capitalization of the entity. Are you going to capitalize the U.S. entity with debt, equity, or perhaps a mix of both? There's some planning opportunities associated with that as well. If, for example, you have a debt instrument, you've infused debt into the U.S. entity, then that can be quite helpful because that can be a repatriation lever for the U.S. entity to pay principal on a debt obligation back to its foreign owner, its non-U.S. owner. If you pay principal on a debt obligation, as you know, Viki, that's not subject to U.S. withholding. But if you pay a dividend, you can often be subject to withholding on that dividend distribution. So consideration of the capital structure is also a pretty big piece. And then depending upon where the investors are coming from, you might have an investor group coming into the U.S. from a country that does not have a tax treaty with the United States, right? So you might have a Brazilian investor group, for example, maybe a Hong Kong investor group. Neither of those jurisdictions has a tax treaty with the U.S. So any distribution then going outbound and repatriating back to the non-U.S. parent company would be subject to withholding, given that there's no tax treaty. So we then have conversations about perhaps coming into the U.S. investment through some sort of treaty protected vehicle. Might we interpose a treaty entity between the ultimate parent and the U.S. operating company so that we can more efficiently repatriate cash up the chain and out to the ultimate beneficial owners?
So we see that this situation a lot in Alabama, just given Germany primarily, but I mean there are certainly other foreign investors here based on our market and the proliferation of companies in the advanced manufacturing related to the Mercedes plant. But I mean, there's certainly others too that we work with as well. So
that's true. And I'm glad you mentioned the LLC issue because we see that a lot with our clients, like reaching out to us, how can we fix this?
Well, and that's actually where we see it a lot too, Viki. And I know we work together on this, where a lot of times, as you mentioned earlier, it's too late to some extent. It's not too late to another extent. All things can be fixed, of course, but we'd rather not fix them. We'd rather have the first crack at it and get it right from the outset. But like you, we see that regularly where someone has made a leap into the U.S. and it's only a year or two later that they realize they did it incorrectly, and now we're there to come in and clean up the mess. And I no disrespect to many very good, very skilled corporate lawyers out there. I'm a lawyer myself, so I'll fall on my sword. But what we do find in the marketplace is that a lot of these companies come inbound. They make their first leap to legal counsel to help them to establish an entity, and legal counsel does just that. And then they're order takers to a large extent. And the client says, "Well, we want to establish an LLC," and the law firm says, "Okay, great, then we'll get going with our articles of association or organization," and they establish the entity. Maybe it's not incumbent upon them in the scope of their engagement to push back and say, "Well, we don't think that's the best idea," because maybe they don't see a whole lot of inbound structuring, and so they wouldn't have occasion to push back on that. But if you can get out in front of it, if you can be one of those practitioners that's at the first seat at the table and say, "Well, no, let's wait a moment. We don't think the LLC is the best form." But that's how it tends to happen in my experience, is that someone got a little too eager. Someone went out to counsel and just established an entity, and there's a year or two lagged before people start to realize the mistake that's been made.
Right, correct. So let's go into the U.S. companies going into foreign markets. What are some of those issues that you see that they need to be aware of?
Right. So now we're going in the other direction, right? Where the U.S. company that's expanding, and that takes different shapes and forms. We have clients that do that for the first time. It's their first foray into a new overseas market. We have others that have done it many, many times and are pretty successful at it. And so we see a broad spectrum of client portfolios in that space. But I think for the company that's making its first leap into that non-US market, one of the primary drivers is a tax issue. And that is known as permanent establishment. That's this notion of taxable nexus, right? So for our viewers, listeners who are more familiar with domestic tax issues, they'll be more familiar with the concept of tax nexus or state nexus. The idea that, you're an Alabama company and you have some folks carrying out activity in California. Have you created a taxable presence or nexus in California? It's similar in its constructs in the international context. The notion of permanent establishment looks at whether or not the activity that you have carried out or you intend to carry out in that other country rises to the level of being so substantive, so tangible, that you have created a taxable presence in that other country. Now, you can scour the Internal Revenue Code backwards and forwards, Viki, as you know. You won't find a definition of permanent establishment in there, right? Nope. This is a treaty-defined concept. So you would look at the treaty between the United States and the other country to determine what gives rise to a permanent establishment or a taxable nexus. And that's a large gating issue, because if we have soft touches, if we have maybe just distribution activity in the other country, there are some carve-outs there, and you likely haven't created a taxable presence. But if, on the other hand, you're putting bricks and mortar there, you have an office, you've emblazoned your company name outside the office door, you have people sitting in an office every day carrying out actual value-added activity, that is typically going to give rise to permanent establishment. And you say, well, why is this so relevant? Well, in order to avoid what can be double and triple taxation, if you believe that you have or will create a permanent establishment, then it's typically best to go ahead and form a legal entity in that other country. That essentially isolates or insulates the U.S. parent company from a tax liability and filing obligations in the other country. So we essentially put in place a wall between the two operations, which is important and helpful from the standpoint of managing your overall effective tax rate. And then from there, Viki, we look at the similar things that we look at here in the U.S. Choice of entity. Much like we have here, there are various different entity choices at your disposal in different countries around the globe. And where it gets a little bit tricky, but very important, is the entity choice in that local country has local country ramifications. But interestingly enough, it also has ramifications here in the United States from a tax perspective. There are certain types of entities that we can form in different countries around the globe that are eligible for a so-called check the box election here in the US. And then there are certain entities that are not eligible for that election. And that can have an immediate reporting and taxable posture ramification for the US parent company. So again, where we see that early mistake made here coming inbound to the US, it's quite similar in the outbound context, where a lot of times you'll have the salespeople, the business development people, they'll run off across the pond, they'll shake hands, kiss babies. I have a great, fantastic opportunity for us in,
I can attest to that,
whatever country, right? And they meet with counsel while they're there. Next thing you know, they come home with articles of incorporation, and we've formed X type of entity. And that entity isn't eligible for a check the box election for US purposes. And so now we've run headfirst into guilty and subpart F issues. I'm working with a client presently, actually, where they formed an entity in another jurisdiction that has just given them fits around guilty inclusions. And instead now they are converting that entity to an eligible entity for US purposes. So they first in the local country now have to fix this by converting the entity type, making it an eligible entity for US purposes, and then they can make the check the box election and alleviate some of these foreign tax credit and guilty issues that they're facing. So again, similar type of lessons. Don't get too far out in front of it without seeking appropriate counsel, because the fix can often take longer and be far more costly than having gotten it right the first time.
And that's one thing I have tried to do with some of my clients, the initial conversation and getting a foreign affiliate involved from, another accounting firm, just to get them started and get all the points taken care of.
That's right, Viki. Yeah. And I think that's where you have, that's where you at JMF have a great opportunity there, right? Because through CPA America and the Crow extended affiliation, you have those relationships, you have the opportunity to really tidily link with local counsel in whatever foreign jurisdiction around the globe. And I think that's a unique really offering that you have for your clients, that it's seamless. You might have a company sitting there in Alabama that says, we're going to expand into, pick your jurisdiction around the globe. Wow, it's a big, scary world out there. Do I have a firm here in Alabama that can help me to do it? And the answer is yes, they do, right? Because you can take it from the local relationship there where you sit and interact with your counterparts that you and Bobby and others in your firm have great relationships with. And it's a turnkey solution for your clients to just be able to step right into that counsel in the other jurisdiction. And now you're working together, right? Now you don't have one work stream in the US, one work stream in the local country. You've got one singular work stream and you're acting in concert. And that's, in my world, I'm a tax geek, but that's tax planning nirvana in my world. I get excited about things like that.
Yeah, I appreciate you mentioning CP America and Crow and our relationships with those groups. About 10 years ago in our firm, we really made the strategic decision to invest in creating an international practice group. Viki's obviously one of our leaders in that group. Bobby Ingram is our practice leader there. We just saw so many more multinational companies in our market. And, it takes a different level of expertise to kind of help those clients get through some of that stuff. So, we made a concerted effort. I mean, Viki, for example, was born and raised in Dresden, Germany. She speaks multiple language, obviously Germany, obviously English, Hungarian. We have other folks that help, in different parts of the world. But I mean, it was a strategic decision on a part of our firm. We've been to Germany multiple times, been a couple of years now due to the COVID. But, those are investments we've made in relationships. Sean, that's where, that's how we've got to work with you a little bit. So, I mean, I think, it takes a special type of advisor to help in these situations. Not every firm in Alabama runs across multinationals.
That's right, Bobby. And you find too that, not not to pivot back to the inbound conversation for a moment, but that's also one of the challenges, is that many of the decisions are made at the home office overseas. And so, like you, I've worked with a number of German inbound companies, fantastic companies to work with, because they are, they're very certain of what they want to accomplish, and they're wonderful clients to work with. The decisions are largely made at the home office, and then they're implemented here on the inbound side. And so to be able to bridge that gap, you need to have the relationships over on the other side of the pond. You can't just sit here in a vacuum and say, okay, well, we'll implement whatever you tell us. You need to have the relationships over there and say, okay, let's sit down together. Yes, we sit over on the other side of the pond and we'll support your local operational activities here in Alabama, for example. But to have that relationship with home office, in my experience, it's absolutely vital. Certainly in the inbound context, and if you can do it in the outbound context, that's very helpful as well. But building those bridges, spending the time over there is absolutely tremendously helpful. And of course, Viki, with your language skills, that always helps too. It's the little things when you're working with clients that mean a lot to them. Bobby and I, we dated ourselves earlier at the top of the program, but when you've been around this a long time, there are little things that you catch in conference calls with clients or introductory calls with clients that are very important to them. I always sort of bristle when I get on a call here. I sit on the East Coast, and I get on a call here, at 10 o'clock in the morning, and the American crew on the call says, good morning to everybody sitting in Germany or the UK or France, and I just, I always find that it's a little thing, and maybe it's a bit of a nit on my part, but I think it conveys something to your to your client that you're aware that they're in a different time zone. It might be closing time for them and they're going home to have dinner with their family. Acknowledge that, say have a good rest of your afternoon, or hope you get out of there soon to go watch the football match in the World Cup in an hour or so, right? Acknowledge those things, because I think that goes a long way to communicating that we're not just sitting here in a vacuum, but we understand that it's a holistic global relationship that we're trying to manage for our clients.
I can agree with that more. Show them that you care, reach out to them, learn a little bit about their culture, things like that. Just the little things. That's what matters.
Absolutely.
All right. So new legislation. Let's talk about the Inflation Reduction Act and also the cleanup and maybe the revision of Forms 5471 and Form 5472.
Yeah, great. I knew you were going to get me there, Viki. So, it's kind of a funny time to talk about new legislation from the standpoint that it was relatively quiet last year on the domestic front. Now, set aside around the globe, outside of the United States, we have a lot of legislation to talk about, right? We have all the post-BEPS initiatives in Europe, ATAD 2, ATAD 3. So there's a lot going on around the globe. But here in the United States, last year was relatively quiet. The administration was not able to push through its proposed international tax legislation in the Build Back Better or the Inflation Reduction Act, for that matter. And so some of those changes that we had thought we might see in terms of GILTI and elsewhere didn't come to fruition. And so it was a bit of a dud in that respect from U.S. legislation, at least as it applies to international taxation last year. But there was one component that I think, if not monitored, could come back to bite us. And that is, as you mentioned, Viki, the Inflation Reduction Act calls upon $80 million of new funding for the IRS. I think 45 million of which is slated for enforcement activities. That's significant. That's a massive leap, and it's something that I think the Wall Street Journal called sending the IRS into beast mode. That is relevant for our purposes here as international tax practitioners. Why? Because I think the low-hanging fruit is around transfer pricing. I think some of the easy enforcement to look at is improper allocation of income between related parties crossing borders. Now, this sounds sort of like an academic exercise. Well, we're saying there's $45 million newly allocated to enforcement. Now we sound the alarm bells and worry about transfer pricing. No, it's not that at all. If we step back for a moment, transfer pricing has been a big ticket item for the IRS for several years now. It has been a high priority item, and they have instituted a number of initiatives within the service to look at, scrub, and focus on cross-border transactions between related parties and the pricing between those related parties. Where do they find those? Where is the roadmap? Where is this not an academic exercise? It's in those forms 5471 and 5472 that you mentioned, Viki. That is where the IRS finds transfer pricing issues. And that's frankly why those forms are there. They're not there out of sport. I know you have a great time completing them, but they're not there just for something for us to do, right? 5471 is your reporting form if you have a U.S. parent company that owns a non-U.S. subsidiary or affiliate. And then the flip is true for Form 5472. You have a U.S. company that has non-U.S. ownership. And within those forms, you are required to disclose your related party transactions. That is the roadmap for the IRS for a transfer pricing audit. And I think the service believes, whether fair or not is a different podcast for a different day, but the service believes that there is failed reporting in those 5471s, 5472s.
Oh, yeah.
The service believes that companies are filing those forms in the absence of underlying what we call contemporaneous documentation, which is required under the regulations. And so it's not an academic issue. It sounds academic on its face, but when you have forms that you file every year, you are inherently taking a position that this is my transfer pricing posture. I'm going to stand by it. And if you want to come challenge me on it, let's have that conversation. That's a pretty big statement if you're going up against beast mode, and they have $45 million now, or $1 billion rather, to engage in new enforcement. That's significant. And so I think, to your point, Viki, where companies really need to be focusing is going back and scrubbing your historic 5471s and 5472s. Have you been filing those correctly? If not, let's get them fixed, and get them fixed sooner rather than later. And have you been filing them along with or contemporaneous with transfer pricing documentation? Do you have intercompany agreements? Do you have a transfer pricing benchmarking study on file at the time in which you're filing those returns? Because there are some reports that we're hearing from different practitioners around the country that the service is taking to a new position whereby if you file a 5471 or a 5472, in the absence of having transfer pricing documentation on file at the time at which you filed those forms, that is akin to having not filed those forms at all.
Oh, wow.
And as you know, Viki, the failure to file penalties for those forms are significant. The 5471 is $10,000. The 5472, the penalty rose to $25,000 after the Jobs Act. So these are not penalties that are for the faint of heart. And I think what everyone should be looking at is the fact that we have new enforcement money. You go typically after the low-hanging fruit. They're not going to make it harder on themselves than they need to. So it's easy to pull a couple forms off the shelf and say, okay, this company has taken a position about its intercompany pricing. Let's ask them some questions about it.
And in my experience, it's very hard to get the information to even complete everything on those forms because they're so time and intensive.
Yeah.
Sorry, time intensive. Just the clients, I feel like they just don't want to give us everything. They're like, why would you need this? Why would you need this? So it's kind of time intensive to prepare them and to submit them.
Completely agree, Viki. It's a great practice pointer, not only for our clients, a subtle nudge for our clients, but also a good practice pointer for other practitioners out there. Is getting in front of it and letting everyone know, hey, this is information that we're going to need to see. We're going to need to see a P&L for the other entity, a balance sheet for the other entity. And I think you're spot on, Viki, with that observation, in that becomes a bit of a client management exercise where, the practitioner in the other country, you say, well, I'd like to see a balance sheet for this entity in India. And they say, well, that won't be prepared for another 4 months.
Yeah.
We have different year end than you have, right? And you say, well, but I need it yesterday because I have a filing obligation and a deadline here. And so that is something that is a constant struggle. And I think the only way to make that struggle a little less onerous is to have early conversations. If you're onboarding a new client or you're working with a client, you say, listen, these are things we're going to need in the course of our representation of you. We want to get out in front of this now and let you know that we don't want to be a pest, but if we have to be a pest, we'll be a pest to get this information from you because it's incumbent upon us to do that. And so I think it's a great observation on your part, Viki. It's something I think clients struggle with on a regular basis. And then, of course, it becomes your problem, your emergency, right, as you're getting compliance done at the end of the year.
Well, we're asking those questions to protect that client. I mean, that's the reality. You need that documentation contemporaneously. We want to have you file on a timely basis. We want to have all the things you need, so when that enforcement action does get in beast mode, they're coming and we have the answers. So it's always better when they come for you to be able to, we have that because we did it contemporaneously. You can't really say, hey, I'll get back to you in 4 months when I get my documentation in order. That's not really an option.
That's right.
That's a great comment, Bobby. And I can tell you, I've seen that in practice. I've literally seen that in practice where the client gets the IDR, right? The information document request. That's how the audit begins. For all things audit typically, but certainly in transfer pricing, it's a really simple IDR. And the IDR is, please provide copies of your intercompany agreements. Please provide copies of your transfer pricing study. And in my experience, where client calls and says, can I get an extension? I can't tell you how many times I've received a phone call from a client and the client says, you're not going to believe this. I had the nicest conversation with this agent, told him I need an extension. Agent said, you know what? Take another couple months. You believe that? And what a nice agent. And I always say, oh, no. That's the agent now is sitting back in the office, feet kicked up on the desk, smelling blood, saying, well, those are the ones I'm going after because they didn't have their house in order. Now we're just going to sink our teeth into them whenever this comes across. Flip side to that is the client that has it all sitting on the shelf collecting dust. They get the IDR, they call the agent, they say, you know what, agent, your office is on, my way home from my office. You mind if I drop that off this afternoon? Agent says, you mean you have it today? Yeah, I have it today. I'll drop it off on my way home from the office. And those are the ones they might ask one or two more follow-up questions, and they largely go away because you have signaled that you have your house in order. You've done your homework. It was contemporaneous with your filings. And so it's a fantastic point, Bobby. There's tremendous value in being prepared and being out in front of that contemporaneous documentation. And, no one ever wants that day to come, but when it does come, if you have it sitting on the shelf collecting dust, that's a good position to be in.
Mm-hmm. I agree.
There's a lot of, you mentioned earlier in formation with debt and equity stacks for new business, new companies, foreign direct investment. So that'd be inbound from our perspective. Hey, you've got to have that debt component that there is a loan agreement. There is an interest rate that's market. Those are the kinds of things that should be easy if an enforcement action asks you questions. I mean, that's blocking and tackling. That's really basic stuff. That gets even before the transfer pricing studies and whatnot. We really got to be that should be easily accomplished.
Agreed. That's foundational stuff, right? So that's stuff where you're having that conversation, as you said, Bobby, with the inbound client, and you say, well, we think it would make sense to infuse some debt into the structure. As we said earlier, it gives you that planning opportunity to pay principal outbound instead of a dividend outbound, eliminate potential withholding. But it's not so simple as just to say, okay, great, we love the idea, on we go. Then you actually have to action it. And actioning it is putting in place a formal loan agreement, making sure you have an arm's length interest rate. And those are all the components. And as you said, Bobby, very blocking and tackling, easy to get right, almost inexcusable to get that wrong and miss that stuff, although we see it missed. But those are the things that if you're doing it right, that should just be part of your initial inbound planning and implementation checklist.
I think we're done with our questions from our side.
You don't have any more. Sean, is there anything else that we ought to be talking about on this? We have a lot of folks that are in if they're listening to this podcast, they're either a multinational or looking to expand into another country one way or the other, and probably looking for these types of things. Is there anything that we haven't touched on that, hey, we should probably get that out there?
Probably a couple of points, Bobby. One, for the company that's making its first leap. So let's take two different company profiles. One, the newer company into making its international leap, and then we'll take two, the more evolved company, if you will. In the newer company, don't ever underestimate the importance of culture when you're jumping into a new environment. And we're all guilty of it. I mean, what have we done here predominantly in this conversation today? We've talked some tax, we've talked some legal, we've talked repatriation and tax legislation. But at the end of the day, you are moving into a new market, in many cases for the first time. Understand the culture. Don't underestimate the culture. You know, the great example I always give is Target stores, right? We're all familiar with Target. Target had always been a domestic U.S. company, and it decided to make its first leap outside of the United States into Canada. And you know, as a born Canadian, I can joke that so many Americans, you know, refer to Canada as the 51st state, sort of take it as, you know, an afterthought. And that's just what Target did. Target went into Canada, opened up a bunch of stores, and within about 24, 36 months, every single one of those stores had been closed. And Target came running back to Minneapolis headquarters with its tail between its legs. And they now teach this as a case study in MBA programs around the country, the failure of Target expanding into Canada. And what did they get wrong? They didn't get wrong the tax or the legal. They knew how to establish entities, capitalize those entities, what type of entity structure. All of that they got right. What they got wrong was they tried to Canadianize the Target stores. And what they learned when the dust settled on the failure was that the Canadian consumer was used to coming down to the US on vacations and going into Target stores and saying, this store is really neat. This is cool. I want this store in our market. And so Target goes and establishes these Target stores throughout Canada, but they Canadianize them. And they look nothing like the Target that we know here in the US. And the Canadian marketplace said, no, that's not what we wanted. We have enough Canadianized stores here. We wanted the American version of Target.
Right.
And so they missed the culture. They misread the culture. And I always tell that as a cautionary tale, because if Target stores, with its unlimited resources, whether it be accountants, lawyers, you know, actuaries, you know, whomever, if they can get Canada wrong, then middle market company in middle USA expanding into the Netherlands or Germany, they can very much get that wrong.
Yep.
So on the company that is making its first leap outside of the United States, do not underestimate the importance of culture. And then for the other company, the more evolved company, I think what those companies should really be focused on these days is just the new world order of international taxation. And I mentioned it in passing earlier. You know, ATAD 2, ATAD 3, that's where international tax legislation is going over the course of the next 5 to 10 years. We've already seen it. I mean, it's hard to believe now it's 10 plus years since the advent of BEPS. And that has influenced tax legislation around the globe. You know, I always point out the US is still not a signatory to the BEPS MLI or multilateral instrument. But if you tell me that BEPS hasn't influenced US tax legislation, I'll push back on that, because I would argue that GILTI, for example, is a direct descendant of the BEPS initiative. And so I think it's instructive for the more evolved company to realize that international tax legislation going forward is going to largely be predicated on substance. Income is going to be allocated where services are performed, where people sit. Long gone are the days of, you know, having mailbox offices and hiring the trust services company to be your office in Luxembourg.
Right.
Those days are gone. Is there good planning still to be had? Absolutely. But it has to be substantive, and it has to tick and tie with where you have actual day-to-day operations and people on the ground performing value-added services. So those would probably be my two parting comments, Bobby, for companies, regardless of where they are in their life cycle. I think companies, the newer companies or newer stage companies expanding, the more evolved companies, everybody has something to think about these days and to be mindful of.
Yeah, I think those are great comments, and we certainly see it with our international practice group clients as well. So, well, I certainly appreciate you spending time with us today. I mean, Sean literally is world renowned for what he does. And we're certainly thankful that he's a friend of the podcast. Isn't that what they say in the podcast world? Not only a friend of the podcast, but a friend of the firm. Certainly, mutual advisor to many of our clients, and he's always good with us to, hey, we've got a couple of questions from a client that we want to bounce ideas off of, and particularly on the structuring side. I mean, I think it always is good to have a couple of minds in the room to kind of, okay, have we thought about it this way? There are plenty of ways to move the blocks around on the page to get an optimal solution for the client. So we certainly appreciate you spending a little bit of time today talking with us. I'm sure we'll get back to you. I made a mental note to we probably should do a transfer pricing podcast in general. I mean, I think a lot of folks on our end, we know we should do it, but why do we really want to do it? I think that it would be a good topic for us to come back to. And, we certainly will continue to push out information for our international clients. I mean, it's a big part of our business now, which, a lot of people don't realize, hey, you're in, small Alabama. Now we have a lot of multinational businesses, and we have, what you would think of as historical manufacturing companies that have been born and raised in Alabama that still sell all over the world. And, sometimes we'll also have operations all over the world. So certainly appreciate your time.
Bobby, you're very, very kind. It was a pleasure to join you and Viki. And I'm a huge JMF fan, and it was great that you would include me. I'm very, very grateful for that, and I look forward to doing another one before too long. But thanks again for having me. Really, really had a good time.
All right, thanks, Sean. Appreciate it.
Thank you.
Viki, thank you for being here too. First time. I think you did a great job.
Thank you.
You have a great role in our firm, and certainly in our international tax practice. We didn't even mention some of the personal international income tax things we do. That'll be another probably podcast that we touch a little bit later. We do a lot of those expat and impat returns for clients and employees of those clients. So we'll get you back out here. Hopefully this experience was a good one. Again, thanks, Sean, for joining us. And we appreciate everybody listening to the JMF Advisor Show. We've got more shows coming. And if you have any ideas for podcasts, we're going to have a couple of, we've got a couple more ready to roll, but we're always looking for new ideas, new folks to speak with. So thank you very much, and be sure to follow us, rate and review, as they say. So good to hear from everyone. Thank you again.
Thank you.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.